Hello students, today I am going to discuss about the cost of preference shares. Till now you are well aware that the cost of capital of a firm is the minimum rate of return expected by its investor. So there is a cost attached even with the preference shares. Though a fixed rate of dividend is payable on preference shares. Though these dividends are being payable at the discretion of board of directors and there is no legal binding to pay dividends. Yet, it does not mean that preference capital is cost free. So the cost of preference capital is a function of dividend expected by its investor. So whatever will be the expectation of an investor of preference capital, the same is going to be the cost for the firm. Usually in the case of preference shares, dividends are paid regularly except when there are no profits to pay dividends. Because in case dividends are not paid to the preference shareholders, it will affect the fundraising capacity of the firm. Now let us discuss that how is the cost of preference shares is being calculated. Basically we have two kinds of preference shares being available to the investors, wherein the number one is irredeemable preference shares and the second one is redeemable preference shares. Now let us discuss the irredeemable preference shares, which we often call it as the perpetual preference shares. Irredeemable preference shares are those shares which cannot be redeemed unless the company is liquidated. So throughout the life of a company, the investors of the preference shares will receive a fixed rate of dividend. So before calculating the cost of irredeemable preference shares, we need to see that what kind of inflows will be there to the investor throughout the life of a firm till the firm is being liquidated. So looking at the timeline, the investor is going to get a fixed rate of dividend. Let us suppose the dividend is D1 in first year. I am putting the value of dividend D2 in second year, D3 in third year and likewise Dn up till n years till the firm is being liquidated. Though I am giving different values for different years for the dividends, but still the amount of dividend which is being paid will remain fixed throughout the life of a project. So if we wish to calculate the present value of all the inflows for the investors, we can easily calculate it by using the formula of time value of money. We have these different inflows throughout the life of a project, so we need to discount it with a fixed cut-off rate. Let us suppose this cut-off rate is being denoted with Kp. So we are discounting each of the inflows with this cut-off rate with respect to the time. So while opening this series, we can also write this as D divided by Kp will give you the present value of all the inflows. So from this formula itself, we can easily calculate the cost of capital of preference shares, which will be equals to D, that is dividends, divided by P, wherein K stands for cost, P stands for preference shares, which in total makes cost of preference shares, and here D stands for dividends, that is fixed dividends, which is being paid to the preference shareholders, and here P is the preference share capital. But in the case of the cost of preference shares, we need not calculate the cost of after tax preference shares, because as you know that only interest is tax deductible while dividends are not tax deductible. Now moving towards the calculation of cost of redeemable preference shares. So in the case of redeemable preference shares, the preference shares will be redeemed after a particular time period. So the inflows of the investors in the case of redeemable preference shares will be like this. Now using the timeline, you can see that the investor will earn D1 dividend in first year, D2 dividends in second year, D3 dividends in third year, likewise for fourth and fifth year. And after 5 years, on the 5th year itself, the preference shares will be redeemed. Therefore, I am adding V5 for denoting the redeemable preference shares. So now using the same formula of timeline, we can calculate the present value of each of the inflows by using an appropriate cutoff rate, which is denoted with KPR, where K stands for cost, P stands for preference shares, and R stands for redeemable preference shares. And whole of this denotes cost of preference shares, which we also call it as the cutoff rate. So using the same cutoff rate, we can calculate the present value of each of the inflows, that is D1, which is discounted by the cutoff rate KPR raised to power the time, and same goes with each of the inflows up till the time when the preference share is being redeemed. This can also be written as sigma from T1 to N dt upon 1 plus KPR, which stands for the cost of preference shares or the cutoff rate raised to power T, plus the same present value of the redeemable preference shares. Now one can easily find out the cost of preference shares by using the hit and trial method, as we have even used by calculating the cost of debt, or we can even use a shortcut formula for the same, wherein the cost of redeemable preference shares stands for dividend which is being paid plus MV, which stands for the maturity value of preference shares, which you can also call it as the redeemable value, minus NP, where NP stands for the net proceeds of preference shares. Whole of this is divided by N, where N stands for the number of years, dividing each of them with 1 by 2 of maturity value in addition with the net proceeds. Here also it may be noted that as dividends are not allowed to be deducted in computation of tax, no adjustment is required for taxes. Thank you.